In a business combination, the parent company can acquire the future subsidiary for cash, stock, debt securities, or whatever, right? I can pay for some, just like anything, I can pay for it in cash. I can give stock for it, or I can raise debt, right? I can raise money through debt. And let's talk about acquiring a company for cash. Well, we have our investment and subsidiary account and credit cash. This is something you should remember from equity method. And we're going to have some tie-ins with the equity method because, as I mentioned before, the fair value method, equity method, and this business combinations acquisition method chapter are all pretty closely related. There's just depending on how much ownership and control of the company you have. So we're going to refer back to all of them as we go along. Now, this is recording an acquisition for cash, just like if you were buying stock in another company, right? You would debit stock, debit investment, credit cash. Nothing too crazy there. Now, recording an acquisition for the common stock of the parent, valued at the fair value, the date transaction closes. Okay, well, this is for common stock. What are we getting? So instead, we're still getting an investment in subsidiary. We're just not using cash now. You would just credit common stock and then credit APIC. Now, APIC, if you have seen this in our chapter so far, you'll remember that this is the internal tracking, essentially, of the gains that you've made over your own common stock's par value. And this will be much more delved out in our equity section. So take a look there if that's confusing, but I'll touch on it quickly because it's important and never hurts to talk about it. Basically, and this is a super simplified version. We'll go into a lot more detail in the equity section. But let's say we issue all of our total stock at $100,000. That's at par value. So I don't know. We could say that's 100,000 shares at $1 par value. Now let's say it doubles to $2 a share. Now the fair value of our stock is $200,000. Well, common stock would be $100,000. Well, for clean numbers, I'll use 3. So right here, $1 par, 100,000 shares. Here, $3 fair market value, 100,000 shares. So what this would be is, let's say it's a $300,000 investment. Common stock is going to be at par value. It's always going to be at par value. If you look at a balance sheet, you'll see that common stock is at par value. And then you get your APIC. And APIC here is actually going to be the $200,000 because this is essentially the gain you've made over your own stock at par value. And this is only for your own treasury stock, right? You're not going to record APIC for a gain you made on investing in Microsoft stock, right? You're not going to do that. That's just a super generalization of what APIC is, right? It's an internal tracking. It's an internal gain tracking system for your own company, tracking the gains in your own stock. All right, adjustments during consolidation and eliminating journal entries. So what accounts for the parent? Remember who we are. Don't forget who we are, right? Don't lose your mind. Don't think we are the subsidiary. Remember in each section who we are, what we're accounting for, right? If we're talking about stock options, we are the company issuing the stock options. We're doing business combinations, we are the acquirer. So what accounts for the parent will be adjusted as a result of the consolidation and as such be in consolidation journal entries. Now, there used to much more likely be SIMs on this. It's a lot less common these days, business combinations, consolidation, journal entries. I'm not saying you shouldn't know it, especially, there still are plenty of multiple choice on it. Just keeping in mind that this used to much more heavily be tested in the Sims. This big journal entry, not as much anymore, but still, a lot of this should make sense because what's happening when you are acquiring a company? So a lot of times this is going to be going from equity method to consolidation method. And let's see. Now, one thing I want to note is that when you consolidate, you eliminate the equity accounts of the subsidiary. That's just a rule, right? It's a rule. It's something we'll see. So that's why we're debiting and we're getting rid of all of the subsidiaries' equity accounts. We consolidate. We only use the equity accounts for the parent. That should make sense, right? These should make sense, right? We're just getting rid of the subsidiaries now. Here, the NCI, as we mentioned, when you buy a company, now if you buy 100, there is no NCI, so that would not exist. But if we are buying, and presumably in this example, maybe we're buying 90%, we are going to record the amount that we don't control of the subsidiary on our balance sheet in the equity section. So we're crediting that, we're increasing it. Also, presumably, we're going from equity method to consolidation method. So we're getting rid of investment in subsidiary. This is only using the equity method. So we're getting rid of that. We're crediting it, right? Because now they are basically us. We are consolidating. We are combining. We are becoming one entity. Now, these accounts, let's see, well, balance sheet adjustment to fair value. These are all included in the calculation of goodwill. That's why these are all grouped together right here, right? So these are grouped together, these are grouped together. Well, basically, if we're going to write up something, right, we're going to have goodwill because we're buying it at more than it's worth. And why do we like revalue at our acquisition? Well, it's just a good time for it, right? So think about companies. I mean, you don't revalue a company every month. A lot of companies, you don't even revalue everything on their balance sheet every year. But what's a good time to revalue something? Well, I would assume it's when you're buying a company, right? I mean, it's kind of important to know the value of the company when someone's buying it. So it's just a great time to revalue or do a valuation. So we're going to revalue. This is real world me talking. Like we'll revalue the company when someone's buying it, and that'll help us to determine the book value. And as such, should we have any adjustments to fair value? And as such, should there be any goodwill? I mean, probably there's going to be goodwill because you're probably not going to buy it, exactly for what it's worth. But that's going to be part of the entry here. Here are just the descriptions of what I was just talking about. So investment in subsidiaries eliminated. All of the subsidiary equity accounts are eliminated. We create NCI, goodwill or gain is created. Now, if you buy it for cheaper than what it's worth, right? If you buy a company if you somehow get a deal on it, we don't have goodwill. We don't use negative goodwill. We would actually credit a gain. It's called a bargain purchase, and it's the opposite. So if you pay less than what the company's worth, that's a gain. So that's the only difference here. So it says goodwill or gain. That would be eliminating the goodwill and crediting a gain. Balance sheet of subsidiaries adjusted to fair value. That's just because, like I said, you're revaluing your company. It's a good time to do it, right? When you're being purchased. Identifiable intangible assets of the subsidiary are recorded at their fair value. Again, revaluation. So memorize this journal entry. This is the big consolidation. When you consolidate journal entry, I would memorize it. I mean, again, are you gonna have to write this out for a sim? Probably not, but this will help you understand the whole process in consolidations, what gets eliminated. I would advise to do so. It's not going to be as bread and butter as, let's say, a depreciation journal entry, right? But super important, and I'm pushing you to memorize that. Definitely advising strongly there. Okay, here's a little graph. We will see numbers later on with this graph, and I'll explain them later. But basically, just wanted to bring your attention here. This is a good sort of diagram to see when you're running through questions. You're gonna just remember you have NCI. Let's say this is 10% of the company, and you own 90% of the company. We'll see this later on. Just want to introduce it to you. You might have seen this before somewhere, and it's pretty common diagram. This is going to help you calculate goodwill, what's included in all of your balance accounts for our consolidation journal entry.